Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of Investips. I'm your host Steve Brice, and this is the second instalment of a three-part series on retirement. Today we will take a deep dive into investment strategies for different age groups as they plan for retirement. Joining me is Trang Nguyen, a senior portfolio manager from our discretionary portfolio management team. Investing is obviously one of the most, if not the most important component in a retirement plan. So depending on where you are in this journey, your individual objectives and your personal circumstances, the right investment strategies may be very different. However, Trang, maybe let's start at the high level. So are there some guidance or tips that you can point to people for different age groups?
So if you are not yet ready for your retirement, especially if you have not been serious about retirement planning, our most important advice is start now. Start saving, start investing today. Of course, this must be done within your means and your financial circumstances. But time is your ally. Take advantage of the compounding power. Our study shows that if you start at the age of 25 using 15% of your salary, assuming a rate of return of 6%, by the time you are 65, you will have about 15 times your annual salary for retirement. Now, but what if you have not been as fortunate or have been busy with other life obligations? You can still work to achieve your investment plan by putting aside more from your salary. So instead of 15, you might have to consider 20 or 30%.
Okay, so obviously starting early is great. If you don't start early, then you can put in more money later and try and play catch up. But what should you be investing in?
So the second important tip is that investment strategy might be different for everyone. However, having enough equity in your portfolio is extremely important. Over the long term, equity is still the most important driver for your overall investment portfolio. For example, people in their 20s or 30s can afford taking more risk by having up to 80 to 90% of equities. This allocation ideally should be reduced to around 60% or 70% as we enter the 40 or 50. However, we believe that even when you enter retirement, you should still have a small allocation to equity to ensure that your investment growth outpaces inflation, especially now that the life expectancy is likely to increase.
Okay, so deciding the appropriate equity allocation is the key to expected returns of an investment portfolio, especially obviously over the long term. On the opposite side, I guess, it's all about taking and managing risk, and one of the key to that is diversification. So, but if you look at different differences across age groups, what do you think the differences are in terms of taking equity risk for different people?
For younger age, people in their 20 or 30, since their time horizon is relatively longer, they can afford taking more risk with less emphasis on diversification. Now, we do believe that for this age group, implementing broad region equities using low-cost products such as ETF or index fund makes sense. Also, diversification to emerging market equities can be another great way to boost return potential over the long term. So diversification play an extremely important role for investors in their 40s or 50s because their portfolio size is likely to be bigger through accumulation from higher earning power, but they're also subject to more life obligations. So for this group, their investment objective is not only about maximizing return potential, but also it must be done without taking a lot of risk. So of course, diversification across regions still can work, but we also believe that investors in this age group can start substituting part of the traditional equity with high dividend equities. This type of equity is still more toward quality and value, hence they're a bit more defensive.
And what about people who are in retirement? Should they be solely focused on income generation?
So for people already in retirement, protection from downside risk is really important. With less equity overall, retiree can focus on developed market equities, which historically have been defensive. or consider implementing through high quality equities. So very importantly, investors in this age group should actively trim the concentrated position to single equity sector, single security, as they tend to be more volatile. However, with life expectancies what they are right now, retirees need to plan for being around for 30, 40 more years. Therefore, an allocation to global equity still makes sense.
Thanks, Trang. That's really helpful. While equity investment is important, in our full reports we also highlight other tips and strategies across different asset classes that you can consider for your portfolio. And for those interested, we also outline different withdrawal strategies with their pros and cons that retirees can consider. So do check out the full reports in the link below for more details. Understanding and implementing the right investment strategy for each stage of life is key to achieving your investment objectives without taking excessive risk. That said, amid all the market uncertainties, one truth stands resolute: the importance of staying invested. It's not about timing the market, but about time in the market. To listen to other parts of the retirement series, you can use the links available in the description box below. If you'd like to follow our market views on an ongoing basis, please listen to our daily Cut to the Chase or weekly Through the Noise podcast series, also available on this channel. Alternatively, you can go to Standard Chartered Wealth Insights on either LinkedIn, Facebook, or YouTube. Thank you for joining us today, and I wish you all the success in your investment journey. Please take care of yourself.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.